Welcome to PortfolioCasts, the podcast where we break down real investor portfolios.
In this episode, we're exploring Stephen Mandel from Lone Pine Capital's portfolio, the key holdings, the concentration, and the thinking behind it.
Looking at Stephen Mandel's latest moves at Lone Pine Capital, you can really see that classic Tiger Cub DNA at work. He's managing a massive $13.9 billion portfolio right now. It is all about concentrated, high-conviction bets on quality growth.
Exactly, Sarah. Mandel doesn't spray and pray. He focuses on companies with real competitive moats. Even with the portfolio seeing a modest 0.65% gain today, the underlying moves tell a much deeper story. HIA is currently sitting on an overall gain of about 1%.
Let's start with the heavy hitter in the portfolio, Meta Platforms. It makes up 7.1% of the total holdings. That is a huge position, worth over $857 million.
It is a cornerstone for him, but he's been trimming. He reduced the position by over 20% recently. That is a significant haircut for a core holding.
Why pull back now? The stock is trading at $648.69. It's actually down about 1.8% today.
I think it's a valuation play. Meta has been on a tear, hitting a 52-week high of $796.25. Mandel might be locking in some gains. Interestingly, the stock is still showing an overall loss of 11.7% for the portfolio.
That's a tough pill to swallow for such a large position. But the fundamentals still look decent, right? I saw some news about Meta hitting the rule of 40, which usually signals a buy for growth investors.
It does. Their price-earnings ratio is sitting at 28.4. For a company with their margins, that's not outrageous. They even started paying a dividend of 0.32%. It's small, but it shows maturity.
It feels like he's balancing that long-term growth with a bit of caution. Speaking of caution, let's look at Taiwan Semiconductor Manufacturing, or TSM. This is another massive slice of the pie at 6.2%.
TSM is the backbone of the AI revolution. Mandel holds over 3 million shares worth $972 million. But just like Meta, he's trimming here too. He reduced the stake by about 11% recently.
That's interesting because TSM is actually a winner for him. He's up over 14% on this position overall. Even with today's drop of 2.7%, bringing the price to $318.68.
The technicals on TSM are a bit wild in the data. The 52-week range is listed between $780 and $1,585. At a current price of $318, it looks like it's trading way below those previous levels.
That's a huge gap. Does the fundamental data support a recovery? The PE ratio is 27.9. That feels fairly valued for a dominant chip maker.
It is, and they have a solid dividend yield of 1.2%. The recent news highlights tailwinds from ASML and the memory market. However, some analysts are saying the stock looks fully priced at these levels. Mandel might agree, which explains the 11% reduction.
He seems to be rotating capital. If he's trimming the tech giants, where is that money going?
One place he's actually buying is LPL Financial Holdings. He increased this position by over 20% recently. It now accounts for 5.5% of the portfolio.
That is a bold move, especially since LPLA took a hit today. It's down over 4.5%, trading at $359.38.
It's a classic Mandel move. LPLA is an infrastructure play for the financial world. He now holds over 2.2 million shares worth about $810 million. Despite today's volatility, he's up 8% on the position overall.
The PE ratio there is 36.2. That's significantly higher than Meta or TSM. Is he paying a premium for that competitive advantage?
He definitely is. LPLA is often cited as one of those profitable stocks with competitive advantages. It has a 52-week range of $262 up to $403. He's buying as it moves toward the upper end of that range.
It's a shift from pure big cap tech into diversified financials. It shows he's looking for growth outside of the standard Silicon Valley names.
Mandel is disciplined. He sees the earnings per share at $10.86 for LPLA and thinks there's more room to run. He's not afraid to add to a winner even when the PE looks a bit stretched.
It's fascinating to see the contrast. Trimming 20% of Meta while adding 20% to LPL Financial. He's clearly reshuffling the deck for the next phase of the market.
He's managing nearly $1 billion in each of these names. When you operate at that scale, every percentage move in allocation represents hundreds of millions of dollars in conviction.
Mike, we left off talking about Stephen Mandel's high-level strategy. I want to dive into some of the specific heavy hitters in this $13.9 billion portfolio. Let's start with Vistra Corp. It's actually one of his largest holdings at 6.7% of the total fund.
Vistra is a fascinating case right now, Sarah. Even though it's a core position, Mandel recently reduced it by over 27%. It's been a rough ride lately. The stock dropped nearly 9% today alone.
That's a massive daily move. And looking at the data, he's down about 21% on that position overall. What's the fundamental story there?
Well, the price-earnings ratio is sitting around 49.9. It's a utility and power company, which usually implies stability, but the volatility has been intense. The 52-week range is wide, from $90 all the way up to $219. Mandel seems to be de-risking here by trimming that position significantly.
On the flip side, he is getting very aggressive with Brookfield Corporation and Philip Morris International. He increased his stake in Brookfield by 81%.
That is a huge conviction move. Brookfield now makes up over 5% of the portfolio, worth about $720 million. It's a classic Mandel play, high-quality alternative asset management. He also added 67% to his Philip Morris position.
Philip Morris feels like a defensive pivot. It carries a 3.8% dividend yield.
Exactly. It's a cash flow play. Even though the position is down about 4% overall, he's clearly doubling down on the value there. The price-to-earnings ratio is much more reasonable at 28 compared to some of his tech bets.
Speaking of tech, I noticed some significant trimming in the Magnificent Seven types. He cut his Amazon.com position by 44% and Microsoft by nearly 35%. Is he losing faith in big tech?
I wouldn't say losing faith, but he's definitely harvesting gains. His Amazon position is still worth $679 million, and he's up 10% on it. Microsoft is a bit different. He's actually down nearly 7% on that one. With Microsoft trading at $483 and a PE of 34, he might be looking for better growth elsewhere.
Where is that growth coming from? Is it AppLovin? That's a 5.8% allocation.
AppLovin is a big one, though he did trim it by 12% recently. It's a volatile stock with a PE of 73. But look at Carvana. That's been a home run for Lone Pine. They haven't touched the position recently, and they are up 19.5%.
Carvana at $450 a share sounds incredible considering where it was a year ago.
It really is. It represents 4.8% of the portfolio. The PE is sky high at 155, which tells you Mandel is betting on massive future earnings growth there. He's comfortable with that Tiger Cub style of high multiple growth.
We also see a lot of new buy signals on the list. Broadcom, CVNA Corp, and New Holdings. CVNA stands out to me because the gain is staggering.
CVNA is the star of the portfolio right now, Sarah. He's up 78% on that position. It's currently worth over $520 million. Even with a PE ratio of 290, he's still buying. That shows incredible confidence in their networking hardware business.
What about the fintech play with New Holdings? He just initiated a buy there.
New Holdings is the parent of Nubank. It's a 3% allocation worth $444 million. It's already up 9% for him. He's also buying into C Limited and Etsy. These are classic e-commerce and digital finance plays that fit his historical research-heavy profile.
It's not all smooth sailing, though. I see Flutter Entertainment is down 16% for the fund.
Yeah, Flutter has been a drag. He trimmed that position by about 7%. It's a similar story with Talent Energy, where he's down nearly 12%. But Mandel is disciplined. He's adding to Talent slightly, about 9%, suggesting he thinks the market has it wrong.
As we wrap up this look at Lone Pine, what's the big takeaway for you, Mike?
Mandel is rotating. He's moving away from the crowded big-cap tech names like Microsoft and Amazon. He's shifting that capital into high-conviction growth like CVNA and Carvana, while balancing the portfolio with heavy hitters in infrastructure and dividends like Brookfield and Philip Morris.
It's a sophisticated balance of aggressive growth and defensive value. A $13.9 billion balancing act.
Exactly. He's staying true to his roots, concentrated positions in companies with real competitive moats. Whether it's a tobacco giant or an AI-driven ad tech firm, the fundamental research is the driver.
Great analysis today, Mike. That's a wrap on our deep dive into Stephen Mandel's latest moves at Lone Pine Capital. Thanks for listening to the Portfolio Report. We'll see you next time. Thanks for listening to PortfolioCasts.
This content is for educational purposes only and should not be considered financial advice.
Any figures, prices, or portfolio values discussed are approximate and used for illustrative purposes only.
Follow PortfolioCasts for more investor portfolio breakdowns.